Hey Shane, how's it going?
Kyle, it's Monday, man. We don't normally do these on Mondays, so that's a little bit of a twist. We got kind of ran out of time last week, man. Things are busy in the Elevate world. We got another new employee joining us starting next week, and things are looking good. So just busy, but want to get a little preview out of the upcoming commentary, which I'm hoping to write most of this week, maybe over the upcoming weekend, and then probably post an email out to our subscribers by maybe the 7th, Monday, 7th of August. That's the same day our new guy Ethan starts. So, um, a lot to do in the next week. We get some month-end data coming up here over the course of this week. So, some of the charts that we're going to go over in this preview probably will update, change a little bit between now and when I actually go and publish the commentary. But um, yeah, I guess we're trying to change up a little bit how we do the Elevate chats and make them, 2 weeks after the commentary comes out and 2 weeks before the next commentary comes out. So we're a little off schedule right now, but we'll get back on it, and hopefully we'll cover a bit of ground here in the next 30 minutes. Um, with that said, you got anything big that you wanted to make sure we talk about today?
No, I think that's a big one right now. We just had the FOMC rate decision last Wednesday, so got a little information out of that, but certainly some fundamentals to look at here. A lot going on under the, surface of the market moves. So
Yeah, I
with
don't really
that,
have even a slide on the Fed or anything yet. I mean, I have the transcript of the press conference saved, so I'll definitely be covering some of that in my commentary. But I mean, before we jump into the first couple charts, what stood out to you, if anything? Because it was no surprise to me that they hiked rates by another 25 basis points. I don't know if you were surprised or if the market was surprised, but I did take a few notes while I was listening to Powell answer questions from the stable of idiots they have in the press corps. And so I got a couple of things, but I don't have a slide on it.
yeah. And I think the big takeaway was I agree with you. It was pretty well forecast, quarter point, rise, nothing there. I think the interesting one is just how kind of vague and open-ended they left it. So it was the first one where it was just kind of like, hey, we have one goal, and there wasn't a ton of context on that. So it kind of left them open to, doing whatever they need to do to make sure they hit their mandates. So that was kind of the big takeaway for me. So nothing too big on that one. Yeah, quarter point rise like we expected, and just kind of left it open.
Yeah, well, I took some notes. I'll just kind of to rip through them here quickly. I'll do a bit more digging on these before publishing a commentary. But again, just as a little bit of a preview, I kind of wrote down that Powell seemed very focused on tighter credit conditions doing the job for him. So banks are not lending as much as they were. They're tightening credit standards. They're not lending to as many people. They're not lending as much money, and that by itself is tightening monetary policy without the Fed having to raise as much. So even if the Fed is not raising by as much, the the economic situation is still getting tighter and tighter just through decreased bank lending. So I mean that's something that the Fed doesn't directly control, but they influence through higher rates, and the banks are preparing for more people to default, which is why they're lending less money to fewer people. Um, I also highlighted the word hope because Powell seemed to say hope a lot. I haven't searched the transcript to see how many times he said it, but just a couple of quotes I highlighted were, "We hope inflation will follow a lower path. This helps us make, I hope, better decisions." So like just lots of hopes, hopes and dreams. Like anybody can win the World Series of poker. All you need is a chip and a chair, right?
Hmm.
And some hope. So I don't know. Powell keeps smoking that hopium. See what happens.
Yep.
Um, he said it was certainly possible that we raise again and possible that we choose to stay level. So, like you said, pretty ambiguous there. One of the goobers in the press corps used the Barbie movie and Taylor Swift concerts to formulate a question to the Federal Reserve Chairman, which I find fascinating. I mean, I just I don't know. I don't I have a feeling Powell's not paying much attention to those things. And then one other guy, what a jerk, just tone deaf. This guy asked, how much are Americans actually being harmed by 3% inflation? Like, only just a thoughtless, tone deaf person would ask such a stupid question. Maybe this guy doesn't have anybody in his family or anybody that he cares about that doesn't make $1 million a year or something. But like, I have people in my family who are like hurting. They're struggling right now. They're walking away from cars. They're thinking about walking away from payments on their house because they simply can't afford to live anymore. I mean, inflation was only 3% last month, call it. That was on top of 9% in June of 2022. So 3% on top of 9% is 12% inflation over the past 2 years. Like, things are more expensive by a lot. Just because they're not going up by as much doesn't mean they've gone back down in price, and they may never. They probably never will. And wages haven't kept pace. So if you're making the median income in the United States of America of $70,000, but prices of everything that you need got 12% more expensive, I mean, yes, Americans are being harmed by inflation at 3%. Like, what a stupid question to ask.
Hmm.
And it really, like, I mean, it really upset me that, like, it's a K-shaped economy. The people who have a ton of money to invest in the stock market, to invest at these higher interest rates, they're doing great. They don't care that eggs are more expensive, or, and anything else is more expensive. I guess eggs have come down a little bit, but the rich get richer and the poor get poorer. I mean, so half of the economy, half the participants of the economy are like, yeah, this is cool, no big deal, I can handle it. And then the other half are like seriously struggling and fighting for their lives, fighting to get by, just to have even the little tiniest bit of enjoyment of their life. They almost all their income is covering needs, the essentials, the electricity bill and the mortgage payment and the grocery bill and gas in the car, and there's nothing left over to go see a Barbie movie, you know? And I mean, don't get me wrong, people make bad decisions too, and they put that Barbie movie on the credit card, which we do have a chart for that. And it's just a matter of time, I think, before this gets even worse. But I just thought that was such a tone deaf question, and I'll
Hmm.
probably hammer that a bit in my letter. Um, And some idiot finally asked about rate cuts. They always ask about rate cuts. And like, literally, Jay Powell, he laughed at him. He like chuckled. He was just like, I don't remember exactly what he said. I'll have to go back and look through the transcript. But my note here is like, he got shot down with a chuckle in response to the follow-up question. He's just like, they actually said, we don't see 2% inflation until 2025 or so, which is in their SPR, their summary of, or economic, or SEP, summary of economic projections from like last quarter. They don't see inflation coming back down to 2% until 2025. So the idea that they're going to cut rates, like, it's a joke. And by the way, they're still reducing the balance sheet. So he said it's possible that they might cut rates while still reducing the balance sheet, which are kind of counterintuitive things. They're in opposition of each other. So reducing interest rates while continuing to unwind the balance sheet seems like kind of, I don't know, self-defeating. Maybe it's a hedge. I don't know, but it's something to think about.
Hmm.
Um, and then there were some questions about the discount window and bank borrowing and bank failures and stuff like that. So I do find it interesting that they keep telling us that the banks are sound and the industry is, stable. And I'm just like, yep, we'll see. Couple more big bankruptcies, and that might not be the case because those banks are failing without their loans failing last time, which was only like a couple months ago. Like, even, I'm not that old, Kyle, but I'm old enough to remember 3 months ago when banks were like failing for no reason at all. You know, it's kind of crazy that happened, and everybody. I mean, people have seemingly forgotten that that's what's going on in our world right now. So
Yep.
I still don't think that's over. I think there will be another shoe to drop there.
Yeah. Yep. Like you said, interesting. We haven't really seen the credit deterioration, but we've seen bank failures already. So
Yeah, normally when
something
banks
else,
fail,
but
it's because the people who borrowed money don't pay it back.
yeah.
We saw them failing before that even happened, and I think that's coming. There was a Wall Street Journal headline this morning, which we'll get to in the first couple slides, If you want to go ahead and throw those slides up, I think we can get into it here. But
Yep.
I mean, I don't think everybody's just doing well. So yeah, these are just some charts like that I may or may not cover um, in our upcoming commentary. Obviously, we'll throw a SPY chart in there. SPY's so overbought right now. It's kind of come out of that channel that's drawn there, that upward sloping channel, and I have the channel drawn from the bottom, right?
Hmm.
So I don't know if that's really valid because it doesn't hit 3 times, but you know those are the lows that I use to draw this channel, and we've got a couple of hits on the upside. And then now, of course, we're broken out and overbought. And, you know, technically speaking, I mean, the 50-day moving average is up. The 200-day moving average is trending up. It's breaking out, overbought. Oh, I guess I have percentages over here instead of the actual price, but we're basically flat from a year ago, from just before, I guess not a year ago, but just before the calendar turned over to 2022,
Yep.
but still not back to the all-time highs. So we'll see what happens from here if we get a break back lower. But it seems to me like the market is long overdue for a little bit of a breather at minimum. And who knows, you could easily see it come all the way back down here to the 200-day moving average before going higher. So um, I don't think we're totally out of the woods yet, but maybe we are. I don't know. Time will tell.
I agree. And I think to, note one thing here too, right back here. So you had in March and then January kind of hit the same level. So it's about 4,600 on the SPX.
Yep.
We're there now. You could definitely see a little consolidation or even a rejection here. So we'll see how it plays out, but wouldn't be surprised at all right here if we just take a little breather.
Yep. Agreed. Yeah, so
And
that's the
then,
market, but then we've got beyond that, we've got the economy. So I don't know if you want to hit the clear button and get those two little circles off. There you go. But yeah, this is the underlying economy that's driving that market. And so, you know, it's not very often that 99-year-old companies file for bankruptcy. So yellow trucks, we've all seen them out there on the highways and byways as we've gone on road trips. You know, unless you're like 101 years old, you know, this has been around for pretty much your entire lifetime, and no longer. That doesn't mean the company will never emerge from bankruptcy or whatever, but they need to restack the deck now. And you know, with 0% artificial interest rates, I'm sure they could have kept this going on for longer and longer and longer. But with interest rates being what they are, they're no longer to keep up the shell game, and they've shut down. They'll be going bankrupt. And, you know, I mean, this stock, like I remember trading it in 2021 because it was like a boring old trucking stock that just kept going higher and higher. I was like, what, why is this thing? The thing went from $5.82 to $15.20 or 15.24, up 160% in 67 days. And I remember buying this thing and just trading the breakout. And then subsequently it dropped from 15 all the way to 3, then bounced from 3 to 8, up 177% in August. And then from August till now, you know, now it's 0. It dropped 100%. So from like $8.50 to 0. And I mean, these issues were there the entire time. So
yep.
the market
And,
can do crazy, crazy things. Stocks can do crazy things that are totally disconnected from the economic reality, and it can stay that way for a lot longer than most people can stay patient.
and then Shane, what do you see in terms of how this might impact, I guess, the overall, stock market, but more importantly, inflation?
Well, you know, it depends. I mean, there's one less trucker out there to carry freight, right? And these guys were doing a lot of less than full truckload freight, which is a smaller business than full truckload. But you know, somebody's going to probably buy their assets, and there's just going to be one fewer option out there, one less competitor out there that might be willing to carry the same load for a lower price, right? So when you consolidate, this is why people don't like monopolies, right? That's why monopolies are technically illegal in this country, is because then one person or one company would get to set an extremely high price for something, and there's nothing anybody could do about it. So what keeps prices low in a well-functioning economy is competition. So you remove competitors, and suddenly you're surprised when it's easier to collude, right? And it's easier to see higher prices. So we'll see if that directly translates to higher trucking prices. You could also look at it like these loads are going to get carried. It's not like, oh, yellow's out of business, so there's less demand for oil. No, there's just going to be relatively more demand for all the truckers that remain who pick up these loads. So I think it will ultimately have at least a marginal upward impact on inflation, because pretty much everything we buy is carried, that last mile by one of these trucks.
I would
Even if
agree.
it comes over on a boat, or, makes it across the country on a train, or, flies on an airplane, that last mile is usually done by one of these big trucks.
Yep, I would agree on that one. So, you saw during the COVID pandemic what supply chains look like, and they're still trying to recover. And now you have this, so that can create a little upward pressure on inflation. So, in breaking down inflation, Shane, you brought this chart out. You want to talk about this a little bit?
Yeah, so on the left, you see the breakdown of inflation and kind of what it was that makes up that 3% headline number. And that 3% headline number includes a big negative number for energy, right? So energy actually took away from, energy was positive here and here and here and here. And suddenly in June, it was negative. And that's because, June of the prior year was this big 9.1. So now we're lapping those harder comps, and everything now going forward is going to be a little bit harder to beat. Um, on the essentially on the downside. And so energy was a big factor last month. It decreased inflation. If so, like if put it this way, if energy was just flat year over year, you know, inflation would have been up, it would have had an uptick of about from 4 to about 4.1% if energy was just flat instead of down by a lot. And what's happening is from, here, if you look from June to June, right? June was the peak in oil prices in 2022. So this from here to here represents a very big drop. Well, where was oil in July of 2022? Well, it was all the way down here. So now, and oil, by the way, has gone up since I drew this. So I'll be updating this chart before we publish a market commentary on it. But you can see that that line is flattening out. So I do not expect to see as much of a negative reduction in inflation, basically from a benefit from energy in July as we saw in June. And pretty much across the market, I'm seeing inflation kind of creep back up, whether it's corn or oil or wheat. Wheat's actually down a good bit today, but for the month of July, it's up still. I believe. I haven't really looked at close, but I did see a
Yeah.
headline that it was down a bit this morning.
Yeah, and those are the big things that, drive inflation. And like you're saying with oil right now, I'm seeing it about $82 a barrel, break through that level, which kind of looks like we might. That's going to take energy a lot higher, or oil.
Yeah, for July, wheat's only up 4% now, but as of a couple days ago, it was up 15%. So, maybe that's some end of the month painting the tape, as we often see in markets. But either way, it looks like wheat's going to be up, corn's going to be up, oil's going to be up. I think sugar, coffee, cocoa, like all these commodities are up again in July. So it seems to me like we're seeing inflation reaccelerate, which doesn't surprise me given the base effects of this being the highest number. Now we're only comping against 8.5 next month, and then 8.3, and then 8.2. And so as this goes lower, it gets harder to show a continued reduction.
Yep. And then next one, so the Fed's been fighting inflation, and then you're seeing the rise in interest rates come through consumer credit. Certainly the goal there is that you can't buy as many, assets out there if you have high credit, or high interest on credit. So Shane, you're highlighting this, and all I see is a big number on the far right-hand side. Tell us about that a little.
Yeah, well, I mean, there's really not much to say about it. It's just unbelievable that this is the average interest rate on your credit card for people who are paying interest, right? So this isn't like people who pay off their balance in full at the end of the month, yeah, I've got a 20% rate on my credit card, even though I have a high credit score, but I don't pay any interest because I pay my credit card off in full at the end of every month. This is on accounts that are assessed interest. So people are really paying this 22%, which means if you've got a $10,000 balance on your credit card at the end of the month, you're going to pay $2,000 over the course of the year, $2,200 over the course of the year in just interest to maintain that amount of debt, on your credit card. That's $183 a month of just interest that you're
Hmm.
paying, just interest. It doesn't get you anything. There's no good or service in that. It's just interest being paid to the credit card company, which decreases your ability to buy more gas or to buy more discretionary items, right? And so when $183 is going straight to interest, that's $183 you don't have to spend on a Taylor Swift ticket or a Barbie movie ticket or Oppenheimer if you'd rather see Oppenheimer, which seems a lot cooler.
Yeah.
Um, but anyway, I mean, this isn't just like some phantom number, like, oh boy, that would suck to pay that. Like people are really paying this. They're really paying 22% a year to carry credit card debt from one month to the next. And like when a lot of these borrowers call their insurance company, I was talking to a guy from church a couple weeks ago. I may have shared this before, but he was told by the credit card company that if he were to pay off his balance in full every month, it would hurt his credit score. That's what he was told when he called them. And I was like, well, dude, that's not true. I mean, anybody who says that is lying through their teeth. Like I can tell you how they calculate a credit score, and carrying a balance from one month to the next does not help you. It,
Hmm.
it simply does not help in any way, shape, or form. That's an outright lie. And you can't be surprised that the credit card company would lie when, if you pay it off in full, then they don't make any money in interest. Shocker that they would lie to you about that. But unfortunately, people do lie. And companies, sometimes you get Enrons out there. They tell really big lies.
Yep.
Uh, it's just the misinformation is astounding, and the lack of financial education is astounding. I mean, if people understood interest, if people understood compound interest, right? Nobody would carry a balance on their credit card ever. Except for maybe in the case of a massive emergency, and then your sole purpose in life is to get that credit card balance back down to zero before you have any fun at all. Because this is just wealth destruction. It's financial suicide to carry credit card debt. Like people who get compound interest earn it, they don't pay it.
Right.
If you understand it, that's the deal. So, yeah, it's a shame.
And then here's another one. So, when you're seeing how that kind of filters through, then hits a lot of other areas, car purchases, consumer goods, and, Elon Musk certainly had something to say on this.
Well, it's just like so credit card interest rates, like we just looked at, are literally at an all-time high. Nominally, the amount of money outstanding in credit card balance is also at an all-time high. I don't have a chart for that. But on top of the fact that the balances and the interest rates are at an all-time high, we're also seeing that the growth in the rate of change in the amount of outstanding credit card debt is literally, you know, growing faster than it has ever grown before, too. So, like, this is a major, major disaster for the economy. And of course, Elon, I don't agree with most of what the guy says. And you can't really believe, if he comes out and says he's got a new product that's going to be available on such and such date, you can pretty much throw that comment straight out the window. But he's also not a total idiot. So I think he's a notorious exaggerator when it comes to product release cycles and like capabilities and calling something full self-driving that absolutely does not drive itself. Um, but he says pretty clearly, like, we don't control macroeconomic conditions. So if interest rates continue to rise, that reduces the affordability of cars and everything else, like Kyle was just saying. For a lot of people, they're really just breaking even every month. So it goes back to what I said about the guy's tone deaf question to the Federal Reserve chairman. Like, Most people are barely breaking even. A lot of people really aren't breaking even. And if you look at the rise in credit card debt, so this is the rise we're talking about, 17.2% year over year in the amount of money on debt. This is scary. It really is. It's scary. And so if this continues to happen, I guarantee you Tesla will have to continue reducing the price of their vehicles. Um, they will earn lower margins, which will make the business trade, at lower multiples in a rational world. We'll see if that actually plays out because people just love to buy Tesla stock for no reason. But economically speaking, it's not something I would want to buy right now, given the margin destruction and inventory building. So they're not selling them fast enough, and they're selling them, the ones they are selling, they're selling at lower prices. Like nobody should be willing to pay this year what they were willing to pay for Tesla in prior years because the business is not it's not as economically valuable. But
Right.
tell that to Mr. Market,
Yeah.
he doesn't care.
Yeah, it can be irrational. And then here's just more, credit, looking at it in terms of, how many people are out there trying to get that credit. And Shane, you highlight some interesting points here.
I haven't studied this. Like I put these together on the day when they kind of come out or come to my attention, and then I move on. So I'm looking at this for the first time in probably a couple of weeks. I don't know exactly when this came out. Obviously within the past 30 days, but so application rate for credit has declined to 40.3% from 40.9%. What's this? For credit card limits, but increased. So I guess it increased for credit cards. So people are overall credits declining, but people are applying for more credit card limit requests, it looks like. The rejection rate has increased. So that's what we talk about, tighter credit conditions. So people who used to be able to get a new credit card or get a debt limit increase are being rejected at higher rates. And the increase was broad-based across age groups, but the highest among scores below 680. So if you got a score below 680, you're probably not getting any extra credit right now. Rejection rate for auto loans also increased, so going to be harder to buy those Tesla vehicles and every other vehicle for that matter. So prices probably will have to come down in the auto market, which means you probably don't want to buy an automaker unless it's Tesla, because it's Tesla. Might as well just buy it because I like those four letters in the ticker. That's the T, the S, the L, and the A are they're my favorite four letters. So I'm gonna buy that stock.
Yeah,
That's about the extent of fundamental analysis going on in the world today.
it is. And you would expect right now with the affordability, it's just, you're not going to see a ton of cars flying off the lot. It's just what's happening.
And then of course the last one, the probability that any loan application will be rejected increased, not just increased, but increased sharply for all loan types. So again, that goes back to the Federal Reserve thinking that the banks are going to do the job for them of tightening the monetary situation in the economy. So they're depending on that, and maybe that will mean they don't have to raise rates as fast. But that doesn't mean that there's looser money in the economy. It doesn't mean that there's not still tightening going on, despite the fact that the Fed might slow down its hike cycle. The banks are reacting to it, and so money's still getting tighter and tighter and tighter. And when that happens, it usually does lead to a recession of some kind. Whether every recession doesn't have to be a great recession or a financial crisis or a depression or whatever, it can just be a normal run of the mill recession and bear market, which usually takes a market down by at least 20%. So we'll see.
Yep. And then, Apple. So we have earnings this week. What remind me, Shane, when do they report?
I think the second. I think it's August 2nd after the bell. So that's what, Wednesday, I guess? Apple reports. Sorry, 8/3 after the bell. 8/3 after the bell. So is that Thursday? Yep, Thursday.
Yep.
So this is interesting. Like people, the Wall Street tends to focus on earnings per share, and that's what you'll see. Oh, they beat expectations of blah 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 earnings per share. So funny enough, earnings per share EPS is here. So in quarter two, it was 1.52, and in quarter three, the most recent quarter that they reported, or sorry, quarter two, 2023. So from one year to the next, sorry, this is quarter two of last year. This is quarter two of this year. So year over year, earnings per share did not change. It was exactly flat at 1.52. However, earnings, let me see if I can erase this. Earnings declined by just a little bit, $744 million. So they earned almost $1 billion less, but the earnings per share stayed the same. So if earnings dropped, but earnings per share stayed the same, the only way that that can be possible is if if the number of shares was reduced meaningfully, which it was. So Apple bought back 490 million of shares of its own stock, which means that the 23,894 of earnings divided by this share count actually stayed the same at 1.52 earnings per share. But so earnings per share stayed flat, but the truth is that Apple earned $744.8 million less for the year than they did in the prior year. Make sense?
It does. So,
Go ahead.
so then the key point we're trying to highlight here, right, is that just looking exclusively at earnings per share is not necessarily the best way, but perhaps you got to take in that whole picture and understand that, just earnings, they're not going up.
Well, yeah, if I came and told you, hey, earnings per share was flat at 1.52, $1.52 this year from last year, you would, I mean, without any other information, you would assume that they earned the same amount of money. But they didn't. They earned
Yeah.
almost $1 billion less money than they did in the prior year. And so that's a great way that Wall Street loves to manipulate things. And here's the even better part is if Wall Street, as a favor to good old Tim Apple, I said Tim Apple on purpose. As a favor, they said, well, we only expect Apple to earn $1.50 per share. Well, suddenly $1.52 beats expectations when all it was flat from last year. So they didn't make any more money. It's not great. Good for you. You beat crappy expectations, but not only that, but you actually made less money overall. And here's the really interesting part is not only did you have less in profits, but you had less in earnings as well. So not only did they earn less money, but they didn't even have as much revenue. Revenue declined by $2.5 billion. That's a lot fewer iPhones being shipped, or the same number at a lower price. However they got there, they made $2.5 billion less than they did in the prior year. And I mean, $2.5 billion to a $3 trillion company isn't much, but $2.5 billion is bigger than I don't know what percent of the S&P 500, or bigger than, I guess, I don't know what percent of the Russell 2000, but it's a lot.
Yeah.
Most small companies are not $2.5 billion in value. So I mean, they lost more in revenue than most companies will ever see in market cap. It's crazy how what kind of a big number that is to do $2.5 billion less in revenue, and yet people want to buy that stock. So ultimately, here's what I come up with is down here in the estimates is, they earned $1.20 a year ago, and currently the estimate for this quarter is only $1.19, but they've already reduced the share count by another 380,000 shares. So if they actually hit the 119 per share EPS number, what that's going to translate to is, I guess, so an EPS decline of 0.01, but actual earnings would be down another 613 million, and revenue would be down another $1.16 billion. So over the course of the past 2 quarters, they've earned a lot, 2.48 billion plus 1.16 billion, so we're now approaching $4 billion a year of revenue decline, and then over $1 billion of less earnings during the same time frame. So the earnings per share game is in fact a game. It's just a game. They can make the number whatever they want. They can buy back however many shares they want in order to manipulate the end number, regardless of how much money they're actually generating in revenue or earnings. And so I just think it's interesting. Most people don't look that far. Most people on Wall Street don't even look that deeply into it. They just say, oh, EPS, blah, blah, blah. But they don't have any idea what was used to generate that EPS number. So I just think that, this is the number one company in the economy. It's the number one holding in QQQ, the NASDAQ ETF, the S&P 500 ETF, the technology ETF. It's the number one holding in basically everything. And if you look under the hood, you find out that revenue and earnings are not only slow, they're not just slowing, they're declining. Like they're earning less money and generating less revenue year over year for several quarters in a row. And so what happens when people finally figure that out is they probably start selling Apple. And when Apple starts going down, it takes everything else with it.
Yep.
So we'll see, how long it takes for that to pan out, if it ever does.
Yeah, it'll be interesting. I mean, big company, kind of near its highs here, and so we'll see. And here's the thing too, when does it all happen? And Shane, just kind of monitoring time here. Looks like maybe got 5 more minutes or so to kind of stick with what we're talking about. But do you want to talk about this on PCE?
Yeah, we'll just quickly. I mean, right now is the time that the Fed's hike in rates finally start to impact consumption growth. So policy tightening begins to meaningfully impact consumption growth 14 to 16 months, and that's where we are right now. So thanks to our friends at Hedgeye for their top-notch research. Got to give credit where it's due. I didn't create this chart. It would take me a long time to recreate it. So appreciate those guys.
Yep. And then here, so exports, great thing to look at. Again, just outside of actually looking at the stocks, trying to figure out what the underlying fundamentals look like. What's your takeaway here?
Well, it tends to lead GDP. Real GDP year over year is usually led by China's exports to the United States. And so when you see this black line seems to be dragging the blue line down, this black line seems to be dragging the blue line down, then the black line drags the blue line up. Well, right now over here, we see the black line has fallen off a cliff. And yes, the blue line has come down off its peaks, but I think there's a lot further to go. And I think GDP over the next several quarters will continue to decline, if not ultimately flip negative. So Chinese exports to the United States tend to lead GDP in both directions. And so right now they're being led much lower. And another thing is just on a nominal basis, back in 2009, I mean, this was minus 23.9%. We're at minus 23.7% right now on exports from China. So I think that's meaningful and something to keep an eye on. And I think we would have to see. I mean, government spending is the only thing that's keeping GDP positive right now anyway. So if it wasn't for the government borrowing money like a madman and pumping that money into the economy, our GDP would probably be negative already. So the other 70%, which is consumer spending, is absolutely awful already. And really all they're doing is stealing from future generations to finance current GDP expansion, which I think is just very short-sighted and probably criminal.
Yep. And then, back to that retail sales number, certainly a declining trend taking place here.
Yep. First time of negative in a while. I mean, we're back to first time of negative retail sales from Redbook since 2021, February 2021. Since I did this chart, we actually got one more week of data that got even worse, and retail sales numbers will come out again on I think tomorrow. Actually, I think we'll get another weekly update tomorrow, which I don't expect to be much better.
And then industrial production, this is the big one I've been looking at, Shane. Just seeing that come down, that's a lot of jobs at stake, as well as GDP growth, all of that, and turning a little negative here.
I would call this an industrial production recession. We are already in it, and that will lead the rest of the economy into recession, absent major interventions from the government. So economic data is not supportive of a market rally here.
Nope. And then here, I thought this was something else. So, Gen Z and millennials just understanding, I guess, how financially independent they are right now. And
Yeah,
this,
or not independent.
yeah,
Financially dependent, I guess is how you'd say it.
yep. So not looking, I mean, the big one here, I'm just looking at this chart here. I am somewhat or very financially dependent on my parents.
Yeah,
And you're
this
sitting here,
right hand side is crazy, dude.
61% for Gen Z, and then millennials, 47%. And Shane, do you remember what the bounds are in age for a millennial?
No, I unfortunately get lumped into the millennials crew. I was born in 1983, so I think I'm like one of the very first millennials. Um, and then Gen Z, I think is like, early 2000s when they were
Mhm.
born. I think, but I don't know. I know there are some different definitions of that, but more great research from Hedgeye here. So these guys put this together, and it blows my mind.
Yep. And then the NASDAQ, it's been going up, but what we've seen is pretty narrow leadership there.
Yeah, and that's led to a surprise rebalancing of the index, which doesn't happen very often. Only happens when things get way, way, way too concentrated. So the big impacts were to Microsoft and Nvidia. So the owner, the operator manager of the QQQs was selling Microsoft and Nvidia to bring down, those allocations in the fund. Doesn't seem to have had a huge impact, although Microsoft shares are down since its earnings. Um, and Nvidia has pulled back a bit from its highs. So we'll see, if there's any real long-term effects, but just something to keep in mind that, even these people who operate this ETF noticed that the concentration was becoming too high, and they had to actually take action to reduce that concentration, because everybody knows, you know, that's not safe for any index or diversification effort to have that much money concentrated in so few companies. So they went ahead and took action to correct that.
Right. And then here we have just total assets, all commercial banks. And man, that's a scary chart. Just looking at that, so we had does not look like a good number in 2002. Our other one's over here in 2010. So that's kind of that European debt crisis and over
Yep.
90. What's your takeaway here? Is this concerning for stocks or?
I don't know about for stocks, but if I were at a small regional bank, I'd be concerned. I
Mhm.
think this is just more evidence that the banks, the Federal Reserve saying that the banks are sound and the financial institutions are safe and strong and so on is just a load of crap, because the data says absolutely the opposite of that. So the percent change, I mean, this just means people are pulling money out of banks. Where are they putting it? They're putting it into the stock market, as we can see from the relentless rise in the S&P 500 and Nvidia and Microsoft and Apple and so on. That people are pulling money out of their bank and putting it into these stocks. That can only go on for as long as everybody, once the last person to buy has bought and there are more sellers left than buyers, what will happen is those stocks will come down and people will panic. They'll take the money out of stocks and put it back in their bank. But if people on average were good at timing the market, we would never see peaks and troughs, right? This is the kind of stuff where you're like, okay, um, people are pulling money out of banks at a rapid pace and they're buying Nvidia and Apple at a rapid pace. Like, how long can that go on for? Well, certainly longer than people can stay patient for the most part, but eventually it will revert. And when
Yep.
it does, you don't want to be stuck with all your money in Nvidia and none in your bank account. You kind of want, at extremes, you want to do the opposite of the herd. You don't
Right.
always want to be contrarian, but at extremes, like this is kind of an extreme. It only happened 4 times, in the past 25 years, maybe in history. I don't know how far the chart goes back, but that's an extreme. And when you're at the extreme, you might want to do the opposite of what it seems like everybody else is doing, which means build up a bank account balance, or a US Treasury balance, as the case may be. Make sure it's in a sound bank, make sure you're under the FDIC limits. But usually this means that there's a drop in the market right around the corner. Time will
Yep.
tell.
And then the big one here is the Fed balance sheet. So all of this really goes back to how much money they're pumping into the economy. And finally, you're seeing it come down. We had that increase a while back that really kind of
That
caught us all off guard.
funny how tiny that little blip is, which
Yeah.
was nothing but saving the banks and throwing them a lifeline so even more of them didn't fail. And that was probably only a temporary fix, is my guess. So um, looks like they've resumed their reduction. And as long as that keeps going down, money's going to keep getting tighter, regardless of whether they hike rates or not. So they can tighten the monetary situation in the economy without hiking rates by simply allowing these balance sheets assets to roll off. And so that's what we expect them to keep doing.
Yep. And then this one, just personal spending. This
Yeah.
is peculiar, I think. So you have an uptick. Um, Good for the economy, or what's going on there?
Well, if you look on the left, personal income has declined month over month, but personal spending has increased month over month. All right, so that leads to this comment. And of course, this comment. What could possibly go wrong when you're earning less but spending more? That's why credit card balances are rising because you don't have any more money to spend. So you go to your credit card to finance that extra spending. And why are you spending more? Well, because stuff costs more. You don't have a choice. You got to spend more. Or you're going to die. You got to feed your kids something, right? And heaven forbid, everybody else at school got to see the Barbie movie and your kid didn't. So you better go put that on a credit card and teach your kids some financial illiteracy. Like when you don't have money, oh, we just put it on the credit card. I don't have to pay it all off next month. I just have to make a little tiny payment. No big deal. We'll just add to the $183 of interest that I'm paying. And as long as I can afford the payment, right? That's what the world says. You just got to be able to afford the payment. Telling you, if you can't afford it, you can't afford it. It
Yep.
has nothing to do with what the payment is. So yeah, this is the world we live in right now, where again the rich are getting richer at an accelerated pace, and the poor are getting poorer at an accelerated pace. And I mean, in the long run, I'm not trying to be like a perma bear here or anything, but like those are the kinds of conditions that lead to civil wars in other countries or in this country in the past.
Hmm.
Anybody who says that can't happen again isn't paying attention. I'm not saying it will happen. I'm not saying we will have a civil war, but I'm telling you, man, the difference between rich and poor is just widening. The tension between Democrat and Republican is increasing. It seems to me like this country has never been further at odds demographically, sociologically, you name it, like polar opposites. There's not a lot of meeting in the middle going on anywhere. And for me, I don't know what will change that. We need we all need something to like point our guns at together, and have a common enemy. And unfortunately, that's usually how a war gets started. Um, so, you know, there's a lot of implications beyond what's going on in the stock market here that will really impact people in this country, and who knows how it will play out. But
Hmm.
I see this stuff and I'm like, man, I don't think the odds are in our favor to be aggressively buying stocks, despite the fact that the market continues to go up, seemingly day after day and month after month. I can be patient for a lot longer than I think most people can, and I'll have plenty of time to invest when the odds are in our favor, which they will be someday. Long-term bullish the United States of America, but in the short term, I see a lot of issues.
Yeah, and Shane, with that, so I'm hearing kind of a bit of a gloomy forecast. Now, how does somebody who did have, we call it jokingly pie chart prison, but somebody who's been fully invested, never did anything, went through this downturn, and now they're sitting here and maybe they're down still, 6% from the highs, maybe a little more. You have a forecast like this. What are the considerations to make? What should they be thinking about?
Oh man. I mean, if you're looking at putting new money to work in the market right now, I would just encourage you to consider using trailing stops and not just blindly throw money into a pie chart allocation of things that you want to hold on to, for the long term. I just don't think returns will be good from here into the long run. But that said, some people don't like active management and they just want to participate in the market for while it's going up and then get off the boat when it starts going down. So I think the best way to do that is by using trailing stops. Um, and that's easier said than done. And a passive pie chart prison type portfolio, that's you. It's kind of hard to mix active management with passive indexes. Like
Mhm.
to me, those two things don't necessarily go together very well. But that said, so, like a lot of people just don't have the patience. They can't stand watching the market go up and have them not be fully invested. And so if that's the case, then yeah, invest in a diversified, you know, group pie chart of exchange traded funds that give you exposure to not just large cap stocks, but also mid cap stocks and small cap stocks, which have lagged this rally. So maybe small caps will take over and do very well as the large caps fall, you know, for the next several months. That's a possibility. Also buy some international and emerging market stocks and maybe even a few bonds, because once rates stop going up, you know, the bonds will probably do pretty well and help diversify. So, you know, if you want to get a pie chart, number one thing for me is don't spend too much money on it. You know, don't pay some advisor 1% management fee to build a pie chart of ETFs. Number one, he'll probably build you a pie chart of ETFs that are expensive, right? Probably be some iShares or whatever. I would say Vanguard's probably got the least expensive diversified passive funds. And then tell your advisor to give you a 50% discount off of what they normally charge because they're not going to do anything with it. They're going to put it in the pie chart and they're going to leave it sit there until you call them and say, hey, I either want to go to cash or I want to go from aggressive to conservative or whatever. And that doesn't really require any work on the advisor's part. He's not managing any money in a pie chart of ETFs. All he's doing is rebalancing it, you know, once a year, picking some funds, maybe doing a little tiny bit of analysis, you know, quarterly, but it's not an actively managed strategy. And then nobody should be getting a 1% management fee for building a pie chart of funds that they just kind of set and forget. So that's why at Elevate, when we do have some clients who are like, hey, your active strategy isn't aggressive enough for me right now. I want to be more aggressive and Shane's too bearish. And so, hey, we got a pie chart option for you. But the difference between our pie chart and most pie charts is number one, we use 100% Vanguard funds. So our pie chart costs about 3 or 4 basis points a year, almost nothing. And then we charge half of our normal management fee. So whatever you're currently paying, we'll cut your management fee in half and probably give you a better pie chart. So
Yep.
if you're going to buy a passive pie chart of funds, the most important thing to focus on is not overpaying for it.
Hmm. Yeah, Shane, and I appreciate that context. That's something important here is that, there's active management, there's passive, and understanding those two and what fits best. But when it does come to passive, a big thing to look out for is just checking the fees because, it just doesn't take that much work. So why pay a bunch of fees for that? So,
Yeah, if you're going to buy the same gallon of milk, why would you rather pay $1 or 50 cents? I mean, hey, and that's outdated. It's more like $5 or $10 at this point. But the point is that if you're getting the same thing, you might as well have the cheaper one, you know?
yep,
So that's what I would look for is a very low cost way to get exposure to the broad market.
yep. So awesome. Well, Shane, thanks for your time. It's been great just, diving through these, fundamentals and seeing really what's going on underneath the surface. We'll see how it all plays out. Nobody ever knows for sure, but certainly some warning signs out there.
Yeah, so be sure to subscribe, like the video, send us questions, and subscribe to our commentary as well, which again I think will be out on August 7th. So we'll try and put a link to the subscription to that commentary if you don't already get it. We'll try and I don't know how to do it, but I'll try and
Yep.
figure it out and put a link to that in the show notes.
Yep. I'll put that down there. So awesome. Well, Shane, thanks again and enjoy your day.
Thanks, man.
Yep. Bye.